Hello, I'm Mark Sturdy and I write the multi-asset technical analysis for 7 Days Ahead each week. And this is just a short introduction to how it's constructed and how it might be of value to you, I hope. If we look at the summary page, the first page is the summary page, which highlights those areas that we think are of a special interest to investors and traders, where the technicals are showing something of consequence. Whether a bullish or bearish scenario, but they are the hot markets. So, for example, in this particular piece of work, the dollar-euro is exciting. We think the S&P 500, the FTSE. So the stock markets are interesting. The dollar-euro, the currencies in particular, not very interesting. The bonds aren't technically exciting at the moment. Oil is interesting, and gold not. If we move on and look inside, the five segments or four segments of currencies, stocks, bonds, and commodities each segment starts with a summary of what we think about the constituents of that category, and then goes into the individuals, starting with a monthly analysis, a weekly, and then a daily in each case. And the reason behind that is that we think that to understand the market, you have to know all the forces acting on it, the long, the medium, and the short term. And the idea is, if you understand what's happening in the long term, medium, and short term, then if they're all pushing in the same direction, that suggests either a very bullish or bearish scenario. If they are in contradiction or contrary influences on the market, then that leads to, it's important to know that, and it's important to know that one should stand aside for clarity. So in this particular case, we think there's something hot happening in the dollar-euro from the summary sheet. So first of all, looking at the monthly chart, we see that there is a parallel channel working the price lower since 2007. The major breakdown point was the breakdown through 120, led to a spike down. It hasn't actually hit the bottom of the channel yet, or even this uptrend. This was going to be a very powerful level, which is parity. We thought it might get there, but it hasn't. And in fact, it may not. If we look at the intermediate chart, we see that there's another diagonal here, which it seems to have bounced off, a rather diffuse area of support. So for the time being, that's held and caused a bounce. What's the nature of that bounce? We have to look into the short-term chart, the daily chart, and sure enough, we see the completion of a double bottom with implications. Measure the height of that double bottom and extend it beyond the completion level, with implications of a move up maybe as far as 118. We were long here, we were buyers here, and we would not be buyers here exactly. We'd wait for a break of the diagonal to buy again. We're buyers above the euro, above the band 118, 114, 111, 114, 16. So it's the three elements that go to make up an overall picture of the forces at work at any one of these markets. I shan't go through all of them, but let's just move on to another interesting chart, the Nikkei 225. This is another of the areas where we have a very firm conviction. It arising out of, as I say, the three separate but important interlocking pictures of the market. Here we have in the monthly chart a massive double bottom in the market. Note that the catalyst for the completion of the double bottom was this continuation triangle there, driving it up through. We see the same triangle on the weekly chart. There's the level from the long-term chart. We also see a minor triangle again pushing it up. Bull continuation triangle, massive double bottom, very strong market. The market looks very strong. If we just move on again, see in the daily chart, less exciting. It actually hasn't gone very far for about a month or so. It's gone sideways, but note that the important support at 19,000 looks very good. Once, twice, three times the market's bounced off it. The market's in good fettle. Bull markets ratchet themselves better by finding good support at prior highs. Horizontals, more important than diagonals. These horizontals are very powerful. While the horizontals remain intact, the market remains bullish. So we are solid in the short term, and we are definitely bullish here. This is for a massive move up. If you measure that double bottom higher, it takes you up to 45,000 or so, and bullish here as well. So that is a powerful picture of bullishness for the Nikkei. Moving on, maybe quickly, we don't see much excitement in these markets, but just another example of how we look at the markets. Oil. the monthly, here's the commodity summary. Here's the monthly oil. Notice long-term oil chart suggests that 40 is powerfully good support. Market hasn't got down there though. There's a Fibonacci cluster here, but it is massive support, massive resistance up here, massive support down here, beginning down here. This is the lowest close in this sell-off. So you have the prior highs acting as good support, the lowest close in the sell-off begins the area of support here, and this is the area of resistance, where the prior low came in and the diagonal was broken. So we see the market is bouncing between in this range between 45 and 75. If we go in closer now to the medium-term image, this shows the bounce has had legs, double bottom here, driving the market up. And here in the day chart, we see that double bottom bounce in greater detail. We think there's further to go. If we measure the power of the double bottom above the market, it takes you to about 73 minimum. We think there's more to go. Going back to the long-term chart, of course, 73, 75 is the beginning of very powerful resistance. So we see the market going up, driven up by a double bottom here in the short-term charts, but it'll be very unlikely to break 75, but we certainly see it possibly going there. These three snapshots of every market comprise our overall picture. We summarize them in each segment there, and we also summarize them in the summary, which focuses the trader's mind on the areas where we think there's interesting dramas happening, something for the trader and investor to get their teeth into. It's worth saying also that in this front page we have a reference to the performance of our recommendations, and in the form on our website, which anyone can have a look at. This is the key trades. This is the specific trading recommendations we produce, and the performance since 2006 of our recommendations, of how well we've done. This is worth spending a bit of time on. It's basically dependent on the level of volatility of how much you want to risk on each trade of a notional fund. So were you to risk just 1%, you would have had this performance over the years, fairly consistent, but of course low volatility. Were you to risk a more realistic, say 4%, you would have had this sort of performance, where 1 million is now between 6 and 7 million. Thanks very much.